last but not the least, we specifically put the fixed income panel to the last because I think this is very much asset class that's it's in everyone's mind. And I think some from the previous panel, a sentence or a phrase really stuck in my head. It's, I think for a fixed income investor, for those of you who are not here, it's very much the past 3 years has gone through some sort of PTSD kind of experience, right? Every year is a roller coaster. You're wondering whether rates have peaked. Is it the year for bonds? And oftentimes it's a roller coaster for a lot of us. But we're here with a panel of experts to really guide us on how we should think about fixed income. And I will pass the mic to the panelists to introduce themselves. But while you introduce yourself, I also wanted to set the stage. And I'm sure it's very close to heart to all of us. It's to the panelists. Do you think this year we'll have any rate cuts? If there are any rate cuts, how many cuts? And where do you think the Fed funds rate will land at in 2024? And I think that will help us set the stage of this conversation. So maybe we'll start with Andy first.
Sure. Thanks, Steffanie. Hello, everyone. My name is Andy Suen. I'm a portfolio manager from Pinebridge Investment. Just a bit background, Pinebridge Investment is active manager. We manage $150 billion across different asset classes globally, of which $12 billion is in Asia fixed income. We are involved in Asian fixed income since 1998 and active across investment grade and high yield. Yeah. So to Stephanie's question, just very briefly, we, at the start of the year, the market was pricing in 6 to 7 cuts for this year. And we have been thinking it's definitely overly optimistic in terms of the pace of rate cut. So we've been assuming 2 to 3 cuts. And with the latest round of data points, we're thinking probably 2 cuts this year. And that's roughly in line with where the futures market is pricing at this juncture. In terms of timing, we think the Fed will be quite patient. It's not really in a rush to cut rates. They need more data points based on the wordings. They need to gain more confidence in terms of the inflation chain. So we think most likely it would be tilting towards later part of this year, talking about September or November. So if it really 2 cuts, that would be like 50 bips lower than the current level.
Thanks, Gabriel.
Thanks, Steffanie. So I'm Gabriel. I'm a portfolio manager at Ping An Asset Management. On the fixed income side, we manage around $5 to $6 billion US dollars of assets, mainly in investment grade bonds, both in Asia as well as global investment grade. A lot of our money also comes from our insurance money, which is why we also focus a lot on high quality credits. To answer Stephanie's question, I think it's quite similar to what Andy just mentioned. So we do think that the rate cuts have been slightly postponed a little bit later. We're leaning towards maybe 1 cut this year. The reason for that is because as we've been seeing inflation tick higher, we think a couple of factors still remain sticky in the CPI figures. And there's been a couple of unexpected developments, such as in autos, and the services sector also remains sticky. So we think that keeps the Fed on hold for a while. Obviously, there's still a lot of points that are uncertain because we still have around 6 to 7 data points from the CPI during this period. So I think this view can change, but that's what we're expecting for now.
Thanks, Stephen.
Good afternoon, everyone. I'm Stephen Chang, a portfolio manager for PIMCO. We manage about 1.8 trillion globally for our clients. And we try both top-down and bottoms-up approach. And from the top-down standpoint about your question, in regards to the Fed, now the Fed, even up to March, was saying that they would cut 75 based on the medium dot plots. I think that would need to revise down somewhat, given what we saw in employment, CPI especially. So our base case is still for 50 basis points, but there are different scenarios around that. Our kind of key indicator to watch is how quickly can CPI print kind of below 3% on the 3-month moving average. Right now, they're not printing below that, so we might need to wait. And again, with some election-related consideration for Fed to stay apolitical, I think that there could be some scope for them to either do it relatively early in, say, July, or they might need to wait till after the election.
Okay, last but not the least, Karan, any chance for a June cut?
Good evening, everyone. So my name is Karan. I work at Barings, representing the public fixed income platform. At Barings, public fixed income is a key part of our sort of asset base as well. More than half of our AUM is in public fixed income assets. Unfortunately, I think my answer is going to be quite similar to the rest of the panelists, so not a lot of ingenuity here, but we are also sort of in the camp of probably 1 to 2 rate cuts, likely beginning in that July timeframe, potentially July, September. Then you start getting into closer to the election cycle as well, which could bring a few sort of factors at play. And that's really because I think the panelists have already discussed it, but there's very little reason for, if you look at the central banks, if you look at the Fed, there's very little reason for them to cut rates right now. Yeah. Economies are generally operating at quite healthy levels. Unemployment rates are very low. And inflation is still a little bit sticky from that sort of 3 handle to go down to their targets. So all things considered, there's very little need for them to go right now. And so that's our case as well.
Thanks for that. So that really set the stage for our conversation. So unfortunately, first half looks like our panelists don't think we're going to get any rate cuts yet. But as what Stephen says, I think we'll start with Stephen from like kind of macro top-down point of view. PIMCO as the largest active fixed income investor. In this kind of environment, we're not looking at rate cuts in the first half. Second half, I think there is also divergence in terms of how the magnitude of the cut. From PIMCO's point of view, how should fixed income investors position for this kind of environment? What kind of main themes we should be aware of?
I think, first of all, we had the COVID shock since 2020, and the policy reaction has been quite varied in some way. The economy have changed in structure depending on the country. And I think this will continue to play out in more diverging manner over the next 6 to 12 months. In fact, we have a forum process where we have all the senior investors gathered together and discussed this in quite a lot of detail in March. And what we come up in terms of conclusion is a theme of what we call diverging markets and diversified portfolios. In terms of the markets or the economies, I think we already talked a little bit about the US, and there should be some continuation of the exceptionalism in terms of them able to deliver relatively decent and positive growth and be less sensitive to interest rate compared to other markets. We have seen central banks in quite a synchronized manner hike rate quite aggressively since 2022. And some markets are already seeing the impact of slower growth, but the US has been quite resilient. And there's some debate whether we're seeing soft landing or no landing in the US, and the data so far seems like it's not really landing yet. But we are seeing some landing in other markets. There are markets that are what I already mentioned about being more interest rate sensitive, so they are slowing quite markedly. There are some markets perhaps in the emerging market space, and they have a different reaction in terms of their monetary policy earlier. So they are now getting back towards an inflation target, which is not having the kind of what we call the last mile problem that you see in the US and elsewhere, where they see inflation kind of spike up a lot, come down, but not quite get to the target. But many emerging markets, you can see those targets already being met, and they started to cut rates. Now, so from a investor standpoint, first of all, about overall fixed income, what we see as the best predictor as the return that you actually achieve is the starting yield level. And the starting yield level is still at very attractive levels. High quality fixed income still giving you 5% plus starting yield. And we are seeing flows coming to the asset class. So I think the market and broad investor are agreeing that's still a very attractive level for them to deploy their cash or their assets into fixed income. Within the US, given what I said about the exceptionalism, we are going to be a little more cautious on duration. So we like the intermediate part of the yield curve. So by that, we don't want to be in cash, because cash, while the level is relatively high, you don't lock it in for a long enough duration for achieving that type of return. But you also don't want to be in the very long end where you are subjecting yourself to a lot of interest rate movements at the same time when the US is still running very high fiscal deficits and needing to issue. What we like in terms of duration, apart from the more intermediate part of the US, would be in countries that I mentioned that are more sensitive to interest rate and starting to slow. That includes places like Australia, Canada, to a lesser extent, UK. So some of those markets we quite like those bonds on a relative value basis compared to the US. And Europe, for example, to us, could also see that kind of growth slowing down and maybe shifting a little bit to foreign exchange. They could be cutting in June and earlier than the Fed, and that could put some downward pressure on their currency. So dollar could still be in a pretty positive environment given the data exceptionalism, given the interest rate level. And so we see the dollar still remaining to be a good, strong currency ahead. But we also at the same time see decent yields, as I mentioned about emerging markets, giving you good real yield and nominal yields. And you can see them achieving the inflation target, so no need to really camp down on growth as much. So emerging markets could be a good way to play a long currency position against maybe shorting in the euro and some of the low-yielding Asia currencies as well. Turning maybe a little bit more towards broader credit asset classes, the valuation is relatively tight, partly because of the starting yield. From a total yield standpoint, is still attractive, so there's still assets being deployed into it. But we are a little bit more worried about the spread level at this moment, so we want to stay relatively liquid and be mindful about being able to avoid maybe more of the cyclical sector just in case the recession risk is still there and spreads are not really compensating you for that. So mortgage-backed assets would be one very high-quality assets that we can own and allocate to. At the same time, you also have the view to get some extra carry through the selling of volatility or expecting the yield to remain within a range, let's say 4 to 5% on US 10-year. So those would be some of the key views, and happy to elaborate further.
Thanks, Stephen. So I think everyone's sort of focused on the Fed, but there are some divergence outside of the US. ECB might be cutting soon. Emerging markets might also look at other scenarios as well. So we started on more a global kind of macro level. Maybe now we look closer to home. I'll sort of point to Andy. Closer to home in terms of Asia, how are Asian markets, Asian central banks sort of reacting to the Fed's very aggressive tightening cycle in the past 2 years? What are the pockets of opportunities you see? And I think in fixed income, there's sort of very sort of specific pockets of opportunities. IG and high yield, how do you think about opportunities in those two segments? Maybe share a little bit with us.
Sure, Steffanie. So starting with the central bank policies in this region, obviously China is in a very different situation. It's facing a deflationary pressure. So we expect the authority to continue to ease policies and putting China aside, the rest of the Asian central banks, we do think there's room to lower rates given the disinflation in the past couple of years, as well as relatively high real rates. But we expect most of them to be more patient. I would wait for the Fed to take action first before really start cutting rates in the respective jurisdictions. But this is okay because if you look at the rate level in the major economies in this region, it's not really that restrictive. The corporates, when they raise funding in the local markets, is still a cheaper cost when compared to the US dollar bond market. So we have been seeing in the past couple of years a shifting in terms of fundraising from the US dollar bond market back to the local market. And that has resulted in a so-called negative net issuance in the Asian US dollar bond market. We continue to expect the investment demand in the form of maturity repayment as well as coupon payment from the bond issuers to exceed the amount of bonds being issued in the primary market. And that will result in a very, very strong technicals Last year was a negative gap of 100 billion. We expect similar figures for this year, and that will be very supportive for Asian investment grade. I think similar to what Stephen mentioned earlier, credit spread as a whole is not really cheap. It's similar to other investment grade markets, trading at the very tight end in the historical range. But then the starting yield is very high. So we expect with that kind of technical and also a stable fundamental profile, spread could be a more resilient than other credit markets. And that's been the case in the past 2 years. Asia investment grade outperformed developed market investment grade in terms of spread tightening, as well as has demonstrated a very low volatility profile. In terms of opportunities within this market, we like the banking sector, particularly the tier 2 securities across the capital structure. The tier 2 credit spread is trading in jurisdictions like Korea, Singapore, Australia. The spread multiple versus senior is 1.5 to 2 times. We think it's still reasonable and has room to compress. Otherwise, we like quasi-sovereign issuers in the region. There's some spread pickup over the sovereign. These names, for example, in Indonesia, they're 100% owned by the government, very, very high strategic importance, and they're providing extra carry and has potential compression opportunities. In high yield, I think as everyone knows, it has been quite challenging the past 2 to 3 years because of the China property sector. But one thing really important to note is that buying Asian high yield today is very different from buying Asian high yield 2 or 3 years ago. 2 or 3 years ago, China property is 35% of the high yield index. Now it's down to mid single digit because of the default and also because of the repayments from some of the survivors in the market. So we think the China property sector will be a less important component for Asian high yield. If we look at the market performance year to date, high yield is up more than 5% total return. It's one of the best performing asset class or fixed income market globally. And that's despite the defaults, ongoing default in China property sector. We do still hold a very cautious view towards China property, but we think the impact on the broader high yield market will be much lower going forward. The rest of the Asian ex-China property high yield, the fundamentals actually quite resilient. Default rate, historical default rate has been very low. Last year is close to 0. We expect this year and next year with the very strong access to the local market funding, the default rate will stay low. Areas we like, including the utility sector, that would include the renewable energy sector in India. We like the consumer sector, that include the Macau gaming sector, for example. The commodity sector we like as well, from a few names in Indonesia, which they have built up the liquidity buffer and actually buying back the US dollar bonds in the public market.
Thanks, Andy. So there are pockets of opportunities in the Asian market, and I think it's a good segue to my next question. We touched upon China, and I think historically for those of us who invested in fixed income, China fixed income, all you can think about is China high yield. Gabriel, as a rep from a Chinese fund house, what's your view on the outlook of China growth as well as China credit? What's the opportunity there? I think a lot of us are the consensus is quite bearish. I mean, the other panel said it's maximum bearish on China equities. Are there opportunities in China fixed income? And I know you also cover green bonds. A lot of interest in green industries in China, obviously. Are there opportunities for investors to think about on the fixed income side as well?
Thanks. So for the Chinese growth, I think the investor consensus right now, as you mentioned, is rightly bearish. For us, I think from an investment point of view, since given the opportunity set, I think there are opportunities there because when we look at the choices that you have in the investment pool, a lot of that is fixated in the investment grade sector. And these are the companies remaining that still have very solid balance sheets or have very strong strategic support. So if we go back a little bit and then we talk about the growth in China, as recently as the GDP figures in China, there was a big upside surprise. But when we go to the line-by-line GDP data points, I think a lot of that is actually weaker than expected. So for example, if we look at the industrial production, retail sales, even export figures, they were below market expectations. And a lot of that, firstly, I think is due to low base. But secondly, we also saw deceleration when we look at first quarter figures, just looking at within the month of March. So I think that tells us that even though the headline figure is stronger, one of the concerns that investors had is whether that's going to delay or postpone or weaken the incentive for the PBOC to launch any stimulus programs. We think the short answer is no, because given that the underlying data still looks weak, the government will still have incentive to stimulate the economy. And the second thing is that when we look at the local government special bond issuance, this year in the first quarter, issuance was just around 12% of the total annual quota. So that's a third of the run rate it was from last year. So the government will have to catch up in terms of bond issuance in the second half of this year, or maybe even as early as the second quarter. So I think that concludes our view that even though we're seeing a little bit more weakness in China, we're seeing a little bit more stability as well, because we expect that the stimulus to come through starting from the second quarter of this year. And going back to the opportunity set, when we look at the markets in China, for our house, we mainly look at the offshore assets. So a lot of that is in a hard currency, especially in the dollar space. And we mainly fixate in the investment grade market. So at the risk of sounding like a broken record, what Stephen and Andy mentioned in terms of a high starting point for rates is very much beneficial to the Chinese markets as well. If we just look at the index in China using the overall investment grade part, we're around a 3 to 4 year duration, which is kind of a very ideal spot, which is intermediate in the curve. And the starting point right now is around, is close to 5%. It's around 4.7% right now. And at this level of rates and volatility, I think is also very low. So the second question becomes, in terms of the spread, so the index spread level is currently around 85 to 90 basis points, which historically is a very, very tight level. It's one of the tightest levels you've seen in the past 15 years. So there's a little bit of a risk that you'll see a little bit of uptick from there, given that if we see further deterioration in the fundamentals of China, and if we see further deterioration in terms of the issuers. But I think there's also very strong technicals supporting this sector, mainly coming from the low onshore rates. So if these firms have to issue, they don't necessarily have to do it in the dollar space. They could do it onshore, which is at least 100 to 150 basis points cheaper for them. So that means that when we have financing, it's going to be net refinancing. So that's going to keep a lid on the credit spreads in the Chinese space. And going to the question about green bonds, I think that this also overspills to the green bond space, meaning that a lot of the issuers in the green bond space in Asia as well as in China tend to be issuers with much stronger credit quality. So a lot of them are maybe state-owned enterprises. A lot of them are banks or financials that are very highly rated. And the technicals, I think, when we look at the market, it's even stronger than what we see for some of the state-owned names, which have captive audience. And the reason for this, I think, firstly, is because we have been seeing stronger investor demand in the sector. So case in point, when we look at the order books of some of the green bonds in the sector, and we compare them quarter on quarter versus non-green bonds or plain vanilla bonds, it's actually been stronger than what we've been seeing relative to history and also relative to non-green sectors. And secondly, we're also seeing a push towards more regulations and better disclosure in the sector, which I think will also help investor understand this asset class a little bit more. So last year, I think there was the ISSB, which is the International Accounting Standards Board, launched a new standard for ESG disclosure. And Hong Kong and Singapore have been one of the forerunners in this area. So Hong Kong is already committed to adhering to this standard by this year. So I think this will also give reason for better disclosure and also help investors understand the sector more, which will increase the fund flow and also investor interest in the sector.
Thanks. Last but not least, Karan. I wanted to pose a question I get a lot from clients, and we kind of alluded to it. the starting point for IG for money market funds, it's 5%. And clients ask, why should I venture up the credit spectrum into high yield or sort of perceived more risky debt? How would you answer that question?
Yeah, sure. So that's a very sort of topical question, and we have seen very strong inflows coming into investment-grade bond markets for the last several months now, and this trend is likely to continue as eventually rates do fall, and you have trillions sitting in money market instruments that eventually get recycled back into capital markets. So we think it's the structural trend, but there are still some good sort of diversification opportunities that we think makes sense to look at markets like high yield. So a couple of points that I would sort of highlight here. The first is, again, when you're investing in high yield or below investment grade rated companies, you're taking first and foremost credit risk. So what is the state of the companies that you're actually investing in? And if you look at the global high yield bond markets, and let's say if we focus more on the US and European markets a little bit, the underlying composition of that market in terms of a credit quality standpoint today is amongst the highest it's ever been on record. So over half of the market today is a BB rated market. If you're looking at it from times, for example, prior to the global financial crisis, where CCCs would have been 15–20+% of the market, it's a much smaller segment today. And then also, as we've seen the sort of evolution and growth in the private credit markets, a lot of the lending that happens in the middle market space is taken up through that channel. And so when you're lending in large public credit markets, you're lending more to large cap companies that generally have stronger relationships with their banks and revolving credit facilities and so forth. So I think the first point is just around the resilience of the quality of companies that you're investing into within the high yield markets. And then related to that is also the actual credit quality or the credit fundamental metrics that you're looking at with these companies. So one, these companies have locked in low borrowing costs in 2020 and 2021 when we had yields falling to record low levels. And then also over the last sort of 2 years or so, we've all been waiting for this recession to come. And so companies have been tightening their sort of capital expenditures, their spending behaviors. You've seen very little M&A, LBO type of activity. And that's meant that from a credit fundamental standpoint, companies are in a much more resilient position today than what you might observe at this point, let's say, in a typical interest rate cycle. And I think sometimes when we're looking at the metrics, a good one to sort of show is something like an interest coverage ratio within the high yield markets. So this is effectively looking at your ability to service your debt obligations or your interest expenses through your earnings profile. And if you're looking at US and European high yield markets today, that's around 5 times earnings. So yes, we expect these metrics to deteriorate as you sort of get later into that cycle, but we do think it's going to be quite a manageable trend. And so overall default rates should remain relatively modest, closer towards long-term averages, and that gives resilience from a high yield perspective. The second point would be, and I think the panelists have sort of touched on this a little bit, is, and Stephen mentioned also things like the resilience and the exceptionalism of the US markets that you are sort of observing a lot as well. Again, if you see a macroeconomic environment where the economy is operating at healthy levels, unemployment rates are quite low, you could very much anticipate being in an environment where interest rates remain higher for longer, because again, you don't need to have that significant amount of rate cuts happening anytime soon. Now, investors have historically, particularly when you're looking at bonds, they've typically tended to be overly focused on the credit risk, and we've talked about things like the recessionary sort of outcomes or concerns that people have had. But interest or investment grade bonds don't come without any price risk. Right? We've seen this in the last few years very, very sort of explicitly, where movements around interest rate expectations can have quite a significant sort of price risk on your investment grade bonds as well. And so even on a year-to-date basis, if you look at sort of return outcomes, investment grade bonds are down about -2%, even though spreads have been quite resilient. And that's because effectively you've had this push out and treasury yields moving higher. If you contrast that with the high yield markets, they've also been hurt by their interest rate sensitivity, but it's a lower proportion of the overall return outcome. And at sort of starting yield levels of 8%, that's given you more buffer to be able to withstand some of these movements in interest rate expectations. And so again, I think from a diversification standpoint, having more of your return coming from income and sort of coupon and being a bit less reliant on interest rate sensitivity can make sense from a portfolio diversification standpoint as well.
Thanks, Grant. We're actually getting quite good questions from the audience. I'm actually going to start asking our panelists. And this is a question that actually I personally wanted to hear from the panelists. And I think we alluded to that at the keynote session where John sort of shared for the upcoming US election, from his point of view, whether it's Biden or Donald Trump, in his view, he says, both, in his words, I think he said they will be both fiscal generous in terms of the way they print money. How does that impact kind of fixed income investing? We look at all the governments around the world. There's a lot of sovereign debt piling up. How should investors think about, are we having a sovereign debt crisis here? And how should we kind of position if we think that's potentially a risk? Maybe I'll start with Stephen.
Yeah, I think that's certainly a very big theme that we have done quite a lot of research on. And as you said, I mean, either one of these scenarios, the fiscal side is not likely to normalize. And it's going to stay at pretty high levels where there will be continued supply of US Treasury. The long end now being inverted versus the front end to us is of very little value as a result. Now, when you look at credit valuation, I think this is also something to keep in mind. If you look at swap versus treasuries, swaps are actually trading lower. That's a very different situation compared to, like, I don't know, call it 20, 25 years ago when treasury was shrinking in supply, the deficits was not there or even in surplus. So right now, we think the situation is, high quality credits will remain in demand, but treasury supply would still be there, and we'll be, again, cautious more on the long end. The intermediate part is where you want to lock in yields. But I think generally that assessment is correct. I think for either one of these kind of presidential election outcome, unless you have a very different makeup for the Congress, I think that fiscal deficit is likely going to stay for some time.
Any comments from the other panelists?
Maybe I'll also jump in a little bit from a perspective of Asian central banks. I think to allude to what Andy also mentioned earlier, I think what fiscal generous will do to U.S. rates as well as to Asian central banks is that it'll keep maybe a floor in terms of how low U.S. rates can go, and also how strong the U.S. dollar it will be. And to that sense, it'll also mean that Asian central banks, who are, I think, to a sense, are Fed following in terms of their rate cut cycle, will have to postpone their rate cuts. And that also applies to the PBOC, which is also one of the reasons why when we saw in April during the PBOC interest rate decision, I think the markets were surprised that there was no rate cut. And I think one of the reasons for that is because they're also closely watching their currency, like countries such as China, Indonesia, or even Malaysia, which are more export-oriented, have a huge dependency on that in terms of making their investment grade interest rate decisions. So I think that will also have an impact in terms of the cycle of central bank decisions within that region.
Thanks. We're actually getting a lot of questions, not surprised, about rates again. So we have questions from the audience. Exactly what kind of data does Fed want to see to be able to trigger them to be confident to start cutting rates? Because Fed consistently said they're data dependent, and I think overnight there are all these headlines that Powell is thinking about higher for longer. And is there a potential scenario, what kind of data would even kind of prompt the Fed to think about hiking rates again? So any responses to that?
Sure, I can kick off. I mean, I think in terms of in terms of data, we've talked about now you've got in the marketplace super core measures. So stripping out your typical food, inflation, sometimes shelter components that have been very sticky in the marketplace as well, and that's been quite slow to sort of come down as well. So, there's many different ways in which you can slice and dice what sort of data dynamics they're looking at, but at the end of the day, when you're looking at the actual outputs that are coming in, whether it's sort of retail sales, whether it's new jobs that are being added to the workforce, the overall sort of GDP growth sort of dynamics that are coming through, and then combine that with a very strong sort of fiscal spending impetus, that's all leading to an environment where there's just very little need right now for the central banks to be able to cut rates. And again, I think from our perspective, it's not necessarily a bad dynamic for financial markets to have this background in terms of, even if you're looking at risk assets, if things are operating well, the Fed doesn't need to cut rates because the economy is humming along at a reasonable state. I think to us, that's not necessarily a bad market environment to be in. If you conversely went the other way when there were lots of rate cuts happening, that's probably happening against a backdrop of maybe a lot more negative news that's coming in, and that might not be as positive as people might envision. So I think lots of data points to look at. In June, we'll get the latest projections of the summary of economic projections from the Fed, and so that will be a good data point to see whether they revise their 3 rate cut expectations to a slightly different number to take into account some of these more stickier prints that have come in recently.
I'll maybe take a crack at this again, and I'm trying to channel my colleague, Richard Clarida, who was the vice chair for the Fed, and he thinks the Fed would get more comfortable, even though they may not get to the 2% inflation target, as long as it's trending down and getting below 3% in terms of some of the more recent moving averages, then the Fed can start cutting with the mindset that the real rate can be lower as inflation comes down. With Fed funds now, call it around 5.25% to 5.5%, if inflation is at 3, then the real rate is at 2. They're probably quite comfortable with that. But if real rates, over the longer term, it might be closer to 0.5% to 1% in terms of the so-called R star for that neutral rate, then they would be pursuing that kind of rate cut towards that. But inflation, like the super core printing at more recently, the moving average is closer to 8%, that's a problem. So I think it is still the inflation data. The dual mandate nature of it is the employment side also need to stay relatively resilient, and so far that is also staying quite strong. Some data point to watch would be unemployment rate, wage growth, and obviously the headline number on the non-farm.
All right, we're almost on time. One last question, and I find it quite interesting. It kind of links to the previous kind of panel's question. I think for a lot of the PMs here, you manage money for both institutional investors as well as funds sort of distributed to retail investors. Do you see any differences in terms of how institutional investors are positioning their fixed income portfolios, which oftentimes the media calls smart money, versus retail money? Any insights on that?
Let me share on this, because we do manage money for both institutional side and as well as retail. I think one key observation, the difference is in terms of the attitude to a duration. I think the institutional money, particularly some of the insurance companies, they start adding duration just because of liability requirement. There's been like a duration gap between asset and liability in the past, and quite some of them are taking opportunity to sort of narrow the gap. It's very difficult to get the precise exact best timing, but with this rate move, it is an opportunity for institutional investors to narrow that kind of duration gap. Otherwise, I think retail is still a bit conservative. It's like what we just discussed. Everyone's guessing when to start the rate cut. But I also echo with what Karan mentioned. Cutting rates too early might not be good for fixed income if it's cutting too early, and another policy mistake resulting in even high inflation that could be problematic. Yeah.
Thanks, Andy. So we're almost at time. I guess to summarize what I heard from the panelists, I think the rate path is still uncertain. Unlikely we see a first cut in first half, and we'll continue to monitor a lot of data. And I think from what we've heard, right, fixed income, unlike, say, equities, it's a lot more complex. There's a lot more technical analysis, and that's why at Endowus we work with these best-in-class active fixed income managers to help us navigate the landscape. And I think Karan also mentioned it's also important to kind of have a diversified portfolio, and you have sort of great managers to help you manage what we mentioned: duration, credit spreads, all the varieties of factors, and we're very happy for all of you to join us today, and I think that wraps up our last panel. And let us all give a round of applause to our panelists for concluding our final panel.